Today we're talking PEG ratios. When I usually am doing this, I'm looking for certain metrics for fundamentals where you can evaluate a company. Okay, one of the ways that's very easy to do that we just went through with Stock Talk is you can look at earnings. Right, we talked about earnings actually last time we were together. We talked about growth rates. Right, so growth rates, it's just a number of it's a number that represents what a company's growth is. How is it, how is it expanding as opposed to just being, right? Growth rates encompass a bunch of different things. They encompass dividends and buyback, stock buybacks, sales, revenue, earnings. It encompasses all of that. So when we start looking at a growth rate there, growth rates are important to look at. But there's a part where you got to take that growth rate and you've got to match it to the actual business of the company, the actual numbers of the company that you're looking at. And so PEG ratios become very important. Let's go to Yahoo Finance. So Yahoo Finance is a place, like, we've been doing this every week. I always pick on Coca-Cola and Pepsi. They're just companies that I like to compare. When we start looking at numbers, right? When you start looking at price to earnings, we've talked about PE ratios before. What happens if you have a company that doesn't make money, right? So far it doesn't make money, and especially some of the ones that Mark talks about, that are maybe underbelly stocks. Well, how do you figure out whether those underbelly stocks are going to be not underbelly forever, right? Are they working themselves in? A really good example of this is Tesla. Okay, for the first number of years that Tesla after they went public, they didn't make actually any money. They were losing money, but that didn't really tell the whole story of Tesla. Obviously, we look at them today; they're very profitable. They're doing pretty well. They're visionary when it comes to the EV space, right? So, is there a way that we can look at these things objectively? And objectively is the key. Is there a way that we can look at a stock and say, okay, even if it's not making money today, we can't necessarily go to the EPS, right, and see, okay, losing money, losing money, right? Is there a way that we can kind of see that maybe there's some potential for that company? A PEG ratio is exactly that. So a PEG ratio is simply, the price is what we pay, earnings is what we get, and then we add into that the growth component. Okay, this is taking your growth rate that we talked about last time and bringing it into the mix, and it comes out to a number. Okay, now that number is somewhat arbitrary in the fact that one company could have a PEG of 1 and one company could have a PEG of 50. Now, one is not necessarily bad or worse than the other, because you have to compare apples to apples. So when we start to use things like price to earnings, we're comparing companies of a similar nature. This is where I take Coca-Cola and I say, okay, it's Coca-Cola, we're gonna match you with Pepsi because we know that you're both in the same business together. This is what you do, right? So we're gonna use those kind of metrics. But we basically just want to see, so if we take the actual PE ratio and we divide it by the growth rate, that comes out to PEG. It comes out to the PEG ratio number. So why is that important? Again, if we have earnings where they're not quite making money yet, as Tesla was a prime example, but all of a sudden, like, actually, maybe I can show you guys that on the chart here. As I find let's see if I can go back far enough to see it. Tesla. All right, let's get some data here. We'll go back 10 years. That might be enough. Go back weekly. And we'll go to OK. All right. So, yeah, geez, it's really hard to see here. So let's just go here. Too much data there. Anyway, I don't know if you guys can see these numbers, but a loss of 292, loss of 304, loss of 300. Okay. So Tesla was having a lot of loss. They had one year where they earned money here, and they still had losses. But what they had was their losses, for the most part, were either staying steady or they were improving. Okay, and we could see that through earnings. But if we were looking at Tesla way back, when all they had was negative earnings, right? Negative. Well, how do we know if they're going to survive? One of the ways that we can figure this out is a PEG ratio. Okay, so we go back to the Yahoo here. So again, we can go in and we can look at a PEG ratio and we can see, okay, is a company, does it have the potential to make money, going forward? That's what we're trying to gain from a PEG ratio. We're trying to see, is it a value? Is it, when we look at it, is it overvalued or undervalued? Does it have the potential to grow into something, down the road? Okay. And so Peter Lynch, he had a metric that he only wanted a PEG of under 1. Okay. He was looking for a PEG of ratio under 1. Okay. For the reality is, it was very, very difficult, in certain market conditions to find those companies that had a PEG ratio of 1. But that number, again, is a subjective value, and it really only worked well if you had something to compare to. And that's what we're going to do here, is we're going to compare the PEG ratio of Coca-Cola to the PEG ratio of Pepsi. And that's going to give us an idea of, okay, if we have a lower PEG ratio, you would consider that maybe undervalued. If you have a higher PEG ratio, you might consider that overvalued, right? Now, you have to understand that these ratios can be a bit subjective because the growth rates are also subjective. Okay, so when we talk about revenue and things like that, sales, right, those numbers are massaged a little bit. So you have to kind of take this with a grain of salt. It's not like this is a hard, fast rule or a hard, fast fact, I guess. You got to kind of look at it objectively and say, okay, in relation to something else, how is this doing, right? So you want to look at the 5-year expected. That's this PEG ratio down here. So right now we can look at Coca-Cola and we can see that we got a PEG ratio of 278. So what does that mean? Well, if you look at Peter Lynch, he says that PEG ratio is too high. You know what I mean? So maybe there's too much of a growth component in there, or the earnings aren't high enough, or the price of the stock is too high. So in that case, it would be overvalued. But if we look at something of a similar nature, and Pepsi would definitely fall in that, well, their PEG ratio is 3.20. So you could make the case that Pepsi is a little bit more expensive, not expensive. Sorry, that's not a good word. Overvalued as compared to Coca-Cola. So you can measure these. Now you can also measure. You can take a number of other companies like Monster Beverage, right? You could say, okay, what does Monster Beverage, look like? Well, their PEG ratio is 3.41, right? So similar space for business, but their ratio is a little bit higher. So you could do that with a number of companies and then come out with a number, a PEG ratio for the sector, right? And you could compare the sector to the company or the company to the company. Okay. And so really, again, it's this undervalued and overvalued. The other thing that you want to look at is you want to look at and see how the earnings is going for a stock. Okay. So this is Coca-Cola here, right? So what we want to do is we want to kind of look at, you can see PE ratio here, that's fine. But we can see the trailing 12 months net earnings per share. Ideally, you want to see that increasing. Now you can see here that even Coca-Cola struggled a little bit, but ideally you want to see that increasing. Okay. If you can see that increasing, then it gives you a good idea of, okay, the earnings per share is going up, as we saw in the chart there. If we look at Tesla now as opposed to Tesla before, we're starting to see that influx of good quality earnings. We can match that with a PEG ratio and say, okay, is that PEG ratio better than their competitors? Okay, so at the end of the day, this is just one of those metrics where we can say, okay, am I getting fair value for the stock that I'm buying? So the price the price is what we pay for $1 of earnings, and that earnings divided by the growth rate gives us a number, and the lower that number, the more we would say it's undervalued. Okay, and so again, we have to compare that apples to apples, and in this case, we compared Pepsi and Coke. Even though their share prices are very different, the PEG ratio gives you a fair comparison between the two companies to say one is overvalued or undervalued at that point in time. So that's your PEG ratio. Again, it's just another tool that we use on a regular basis to see if we're going to get involved with something. Looking at that PEG ratio can give us a glimpse into, are we getting fair value for the expected growth, including the actual dollars that we're getting through earnings. Okay.
Very nicely done. Very nicely done. Market's fighting. They've been fighting the hour we've been doing it. Not a lot changes going back and forth into this range. It'll be interesting to see how the short term of this. It'll be interesting to see how the end of the day goes, right?
Very
Uh,
much.
really just at a short term inflection point. Final thoughts as we end the halftime show, Greg.
Yeah, we always say this, and we can never say it enough. Be patient, right? You don't have to be fully involved in the markets all the time, right? When you have these inflection points, why put yourself in a position where you don't have an edge, right? And right now, nobody's got it. The Bulls don't have it. The Bears don't have it. Nobody's got an edge right now. So why play the game? The beauty of being a retail trader is we could sit back and say, "Hey, market, you figure your own demons out. We'll get involved later when things are more clear." And that's really my final thought for the day. Just wait for some clarity. Clarity works.